Good morning, I'm Chris Beach, and welcome to Charting the Markets on IG Live. And it's a slower start to the morning for European indices, although US futures are beginning to tick higher. It was certainly a lackluster start to the week yesterday. A lot of the momentum we've seen in risk assets, particularly in stocks, over the past month has faded. The big ticket news is out the way for the time being. Earnings season is, to all intents and purposes, over. And stocks just look a little tired after their run high. It's nearly month end, which is always can be a reason for people just to slow down their activity. Certainly fund managers looking to round things up for the end of the month. And then you've got moving into the final month of the year. So it's not surprising that maybe it's a quieter week. Of course, last week ended very quietly with the US holiday, but with little in the way of really big events this week. There's not too much to drive activity. The IPO market certainly seems to be hotting up, which is a bit of a change from the last few months. Really reports that key companies like fast fashion retailer Shine in China are looking at going public next year. So that's providing perhaps signs that investors are becoming slightly more confident about the outlook for the year ahead. Otherwise, looking for the rest of the day, you've got US consumer confidence this afternoon, the big economic event of the day, although even that shouldn't move markets too much. You have got quite a few central bank speakers tonight as well. Not scheduled to say anything particularly earth-shattering or indeed speaking anything particularly important, but there's always a risk that they might say something. You had Christine Lagarde yesterday just pouring some cold water on risk appetite, saying that job growth could continue to slow into the end of the year, and once again there were no plans to cut rates anytime soon in the Eurozone, despite all the poor data we've seen from that economy over the past year or so. But let's start with the indices. We'll start with Dow, which currently trades at 35,357, continuing to consolidate really around its highest level since late August. And really still on course to hit these August highs in fairly short order. We're only about 300 points away from that. So it wouldn't take much of a jump really for the Dow to hit that. Just a couple of days really of gains could see us move into that August high. And then above that, you really have to target, to zoom out the chart, we have to go towards those 10th of February highs, 35,860. Beyond that, then you're pushing into levels we haven't seen since January of 2022, and indeed the very beginning of 2022, the record high at 36,954 is a sort of medium-term goal. Whilst momentum, this applies to all three indices we're looking at this morning, whilst momentum has slowed over the past few days, this sort of straight line move from the lows of October has certainly slowed down. We're not really seeing any kind of massive reversal, it has to be said. For the moment, buyers are holding on. Sellers have been unable to push this one lower. Certainly closed below 35,000 and back below these highs from late August and early September would be a short-term negative development, I think. After the huge gains, it wouldn't be surprising to see at least some kind of pullback. We really haven't had one since really the beginning of the month and the consolidation early November. But at the moment, the buyers are still firmly in charge on this index as well. Looking to the Nasdaq, the Tech 100, we briefly moved above 16,000 last week. We touched it again yesterday, couldn't quite sustain those gains, but trying to nudge higher again. So right back where we were in mid-July. The summer pullback, turns out what you should have done was sell in July and then come back again at the end of October rather than sell in May, as the old adage has it. But we were pulling back from those highs. We have indeed exceeded those highs as of last week. So higher high, buyers still firmly in charge there as well. It's interesting how for the Nasdaq, it was actually less of a parabolic move than the Dow, really. The Dow really went vertical in early November, whereas the Nasdaq, it's been a bit more moderate, although we've still gained about 2,000 points in the space of a month. Beyond that, and again, zooming out the chart, we are really knocking on the highs, will be in very short order if we see further gains into the end of the year, back at these record highs from November, December of 2021. So the round trip is finished. It's taken us just about 12, 13 months so far from the October lows, but we are back again where we were at the end of 2021, and still no US recession in sight. Similarly, as with the Dow, the Nasdaq, no sign that sellers have really been able to assert control here, although a close back below 15,760, which was the late July high, would be, I think, a short-term negative development, and could see us maybe drop back towards the 100-day moving average, or this 15,335 support level, potential support level, which was a mid-October high. Japan consolidating as well, really. I mean, it has dropped for 4 days in a row, so that's putting some pressure on the index. Once again, we are back below these highs from August and September. You have to remember for these indices that if you look even for the Nikkei, which is a relatively measured move, we gained about 12% in less than a month. So some kind of consolidation, short-term pullback would not be surprising. And yes, I'm sure, like me, you've seen all the comments about the VIX being at its lowest levels in over 3 years. This does not mean that some kind of massive stock market correction is upon us simply because the VIX is at low levels. The VIX could keep going lower, but it is perhaps a sign that maybe in the short term, some consolidation, some short-term profit taking, call it what you will, is due, and month end would be as good a time as any for that, really. People booking gains. I know the phrase profit taking gets quite a lot of stick, really is, and it's an excuse that people use when they're not sure what's happening, but it is a thing. It wouldn't be surprising for some people just to cut back on some allocations to stocks after this huge run higher. But I think what we have learned as a general point, really, for indices, looking at the Nikkei, we're still back on course to hit these June highs very, very soon. But looking there, this bounce from the October lows has really restored the bullish view. We've moved above trendline resistance for the Nikkei, just about. We've moved above it for the Dow and the Nasdaq. Where we're not seeing it is in European indices, FTSE 100 week this morning, but other markets around the globe are showing renewed signs of strength. So the buyers still firmly in charge for the time being. And then looking at FX markets, dollar weakness has again been one of the other themes of the past 2 months, really, as markets continue to price in expectations of Fed rate cuts next year. I suspect they are getting ahead of themselves once again. I don't think the Fed will move too quickly on rate cuts, although you might argue if it wants a soft landing, it might need to preemptively cut rates, but that's a discussion for another time. But nonetheless, it has given space for stuff like euro dollar, as we can see on the chart here, to move back to its highest levels now since mid-August. Again, quite the round trip here too. Huge declines from the July highs of 112 all the way down to 105. And then since then, quite a decent recovery here. Question is now, how much further can it go? The fact it's moved above the 50 and then the 200-day moving average and has been crucially able to move above this late August, early September high around 109 sends another message. I think that buyers continue to drive this one. If it had faltered below this late August high, that would have been a signal that maybe we were still in lower high territory. And that doesn't appear to be the case now. I think for that to happen, we need to see it go back below the 200-day, which is always a useful line in the sand, in my opinion. So buyers still in charge here, with the next line to watch for being 110, 110.30, which we last saw in early August of this year. Moving to the euro against the pound, this one's really taken quite a knock, I think, and what was a steady recovery from the lows of August. I'm just redrawing a trend line as ever, just to sort of illustrate the trend line break. But this uptrend is certainly really coming under a lot of pressure now, and it's falling into a neutral territory. I think if we'd held above trendline support, you could have argued it's still a higher low. Indeed, if we'd held above the 200-day, you could have argued it's still a higher low. But now it's really beginning to look a bit dicey. I think buyers would need to see it back above 86.90 and then really back above 87 to say, okay, we have arrested the decline for the time being. Otherwise, now might be the point where you wonder, well, if it does bounce, say, towards the 200-day and then fail to get back above it and continues lower, and perhaps that's your signal that we are due a new move to the downside for the euro against the pound. And that's definitely something I think to watch. Perhaps there's some bearishness about the European economy really coming through here. So this uptrend, which started in late August, really probably is at least parked for the time being. It's certainly not gone completely, but certainly is parked for the time being. And I think you'd have to see a lot more price action back above 87 to suggest that yet again the buyers have couped this one. It's always possible, but at the moment it doesn't seem like that's happening. And then finally, with the Aussie dollar, always a great indicator of risk appetite, back above the 200-day moving average now for the first time since late July. So the risk appetite recovery vibes are definitely with the Aussie as well. And that comes even as central banks begin to rein in their tightening efforts. But for the Australian dollar, it does mark an impressive recovery. Really, because we're back above these late June lows rather, that's a strong signal. And again, above the 200-day would tend to reinforce the short-term bullish view. Maybe if we get a drop back below 65.50, that would sort of damage that quite a bit. But again, strength in the weakness in the US dollar, strength in the Aussie dollar is seeing quite a turnaround here. I would actually just caution, this is one definitely to keep an eye on, but this is the weekly chart for Aussie dollar, and that's still a very impressive downtrend. Really, that's the key thing to look for. It could suggest that looking at the weekly chart, we could go back to sort of 67, 80, even to 68 and still be very much in a downtrend. So it's something to bear in mind here that the longer term view is a bit negative, really. But certainly in the short term, sticking with the daily chart, there seems to be further upside coming through. I'll get my chart. There we go. Yes, quite a decent recovery here in the short term for the Aussie, and maybe some further upside to come. You can see that weekly trend line there coming into the picture here up towards 68. And then moving to commodity markets, gold catching all the attention this week while it loads. I think Wi-Fi connections. While we get some moves back towards $2,000 an ounce, so that's interesting recovery there. Here we go. Moving back above these early October, early November highs around 2007. And that really sends a strong message. The fact it bounced the 200-day moving average as well, another solid sign the buyers are willing to drive this one higher. Again, this is the kind of thing you'd expect to see. Markets rally sharply, it gains 12%, 11, 12%, and then it pulls back 3%, and that moves back to the upside once again. So things rarely move in straight lines in markets for any extended period. Sometimes they do, but this is the kind of thing we would have expected to see. When analysts were saying maybe at the end of October, gold is due a pullback, we did get one. And then the buyers came in, defended the 200-day, defended a support line, and then we moved back to the upside once again. So onwards towards 2060 now in the medium term, not necessarily in the short term. And also we're looking at a bit of trendline support coming through from that November low. So that's also something to bear in mind. Move back below. If it moves back below 2000, it would break trendline support, but that's quite a sharp trend line to bear in mind. So there might not be entirely the complete end of this short-term bounce. And then finally, moving to crude oil, taking an absolute walloping over the past 2 months or so, stabilizing for the time being. Let's not count crude out for the time too much, because again, if as seems likely economic forecasts want to improve, then you'd expect oil demand to tick up a bit as well, and that might lead to a rally in the price. So it does look like it wants to try and make at least another decent move higher to create possibly a lower high. That'd be something to watch if it rallies maybe to 84, 85, and then turns lower once again, because you've certainly had lower highs and lower lows over the past couple of months. A lot more work to be done before we could say, okay, we would be comfortable with going, with really putting an uptrend back in play. So I definitely want to watch with an initial hurdle here around 82.60, which is where the gains over the past 2 or 3 weeks have stalled to the downside. Move back below these lows from mid-November around 77.60 would be the key development, really, and could even open up and move back down towards these May and June lows at 72. But that'd be quite a big move and would probably require quite a dampening of sentiment for the time being. So looking at the rest of the day, as I say, we've got US consumer conference 3 p.m, the only real event of note today on the economic calendar, though all these speakers from Fed, the ECB and the Bank of England tonight, US later in the evening for the UK, could cause some volatility, although I expect them probably to stick to the line of no rate cuts anytime soon. We don't want to get too excitable on that front, so just watch out for that one. Otherwise, we're expecting the Dow to open around about 20 points higher from yesterday's close, where it lost about 50 points. So a slightly positive open to US markets, which helps to an extent to counteract slightly negative tone we had in European markets this morning. That's it for me. Thank you for joining us, and we will see you again tomorrow at 10:30.